Welcome back to the best pro for you trading floor. Today we are focusing on Brent oil. Why Brent and not WTI? Well, because Brent is seaborne oil, and that makes it significantly more sensitive to the geopolitical risk in the Strait of Hormuz. In fact, the spread between Brent and WTI recently hit an 11-year high due to these supply conditions. Let's not forget, WTI is West Texas, right? And it's a shale oil, and the US also is selling oil currently, so it's not really as at risk as it is as Brent is. Volatility here is extreme, and if you are trading prop challenge, this is where fortunes are made or accounts are blown. So either way, you have to be cautious. We saw, of course, an insane drop yesterday, a 13% decline over here. Okay, first, second, third attempt fails, we crash. What happened? President Trump instructed the Department of Defense Department of War, actually, to postpone strikes on Iran's energy infrastructure for 5 days. And he did say that was after they had productive talks. That sent, of course, Brent plunging back under the 100 at 93, let's call it. And it currently struggles to get through the 100. Now, meanwhile, Iran is still firing missiles, and the passes of Hormuz, of course, is exclusively open to those exchanging in yuan and blocking only US-Israeli linked cargo, which is important to remember for context, because the oil passage is not restricted per se. It is, but it's not per se. You know, there are conditions that India, for example, received oil the other day from Iran. So there you have it. This is a bearish catalyst, if that makes sense. Now, here's something important. Iran came out and said, we haven't had any talks with Trump. So here's what happened then. Comes Tuesday morning and prices are moving up. But we have this very important resistance level to take into account. Okay? This might initially look like there is a reversal, but in the grand scheme of this macro environment, it might just be a very sort of short-lived move to the upside. We're overly overbought, okay, and we have actually just kind of reset because we came at 60. We could go lower at 50. That would align with a move down to the median Bollinger Band at 87. Okay. The most critical level to pay attention to in the very short term is the 50 Fibonacci of the yesterday's open to close, which brings us at $103 per barrel. To the upside, we could equally go and, well, look at the breakout and all the way to the upside. Look where we are. We came at the 50. So the 93 and the 103 are currently the levels that we need to pay attention to. Obviously, the 93 might be a little bit further out in the short to medium term rather than just short term, but it is what it is. The important thing to mention here is that this could be simply a reset. And that's the one thing to remember. The second thing to remember is as long as we're below 103, the next level is 87. And it might be confirmed with another confluence factor. Let's go down on the 4-hour. What does the 4-hour tell us? We're going to look, of course, that we're going to see that we have a consolidation despite the high volatility and the upward slope, because it is important contextually. When bands flatten after massive volatility, we expect a violent breakout in either direction. So if we stay trapped between, let's say, 96 and also the top, which is 112, I know it's close to a high, but it's still the consolidation range. Now we're just at the bottom of the range, okay? Then it's likely that we're forming a pennant or a triangle. Why do I say this? Well, because it's easily identified. You see that? And we are consolidating within this range, tightening. Now, when pennants or triangles break, they are continuation patterns. So in the medium term, that should be a bullish indication. However, we cannot dismiss the fact that this also acts as a potential double top. Okay, and here's the thing. When we have a double top, we have the two tops and we have the neckline. The neckline is, well, to be honest, officially down here. Okay, so this would be the top, the double. The neckline break is what is going to actually officially declare this as a double top pattern. Okay, so just keep that in mind. Now, we need to remember that when prices are not highs and lows do not touch one another, we have an impulse structure versus corrective. So far, a lot of traders will consider this as a correction and potential continuation to the upside, which is possible. Actually, in the short term, I think we're going up. And we're going up to 109, which is the high momentum candle, the opening of that candle, right? But we need to break 104 and 103, as we said before, is a very important level, the 50 Fibo. And the 104 is the middle band. Without breaking 104, probably more downside coming. Now, here's the interesting thing. Let's go down on the 1 hour. I want to show you something here. If we look at the 1 hour chart, we're going to see that there is some retesting of this territory, which would render this entire structure as corrective. However, there is something important. In Elliott wave terms, when we see 5 wave legs, the 4th wave is typically a sideways correction. And look at this. This so far sideways correction is an A, B, C, D, and E potential triangle, and then we could go lower. Now, here's the interesting thing, and I will just make that a bit more clear. If you see at the bottom, which is at 180, this is exactly where we came to. And what matters in these terms is not where we saw a high, it's where the pattern ends. And this triangle pattern ends at 180, which is below that wave. So technically speaking, on the 1 hour, and as long as we are at the this moment that this could be invalidated, this is still an impulse. So we could see further downside. But do I think that? Well, we don't know. The 1 hour chart is very, very, it's like, it looks like there is a signal for a breakout. We're in a tightening consolidation and the RSI is dead flat at the 50 line. Okay, the breakout looks imminent. If we break to the upside, I expect a fast move back up to 102, 107 after 3 and 4, and then the high momentum candle at around 109. Now, if this is a wave 4 or a wave 5 impulse, we're going to see to the downside a breakout. That means we are triggering that measured move, and I will show you which one. That is the 4-hour range of the Bollinger Band, which goes at the breakout level, which is the Bollinger Band, and brings us down below the 80, which is confirmed, as previously said, as a potential target. Measured move also shows us that level, and if we look at the breakout, which is right here, again, we see a downside target close 70, which is a very strong support level as well. But without, of course, we have, it's like stages that markets are moving. But I just wanted to point to you that we typically use the 4-hour range of the Bollinger Bands to have a target evaluation to the downside. For best prop for you traders, the 100 mark, of course, currently is the pivot. If we reclaim it and push through 103, the bullish trend likely resumes. If we reject 100 and break the 1-hour consolidation to the downside, I will be looking at the prior support first, the bottom of the lowest point of the band, okay, and then we were looking at, what was it? Well, to be fair, we can easily use our Fibonacci tool here and come down to 100 and 1618 and the 200 Fibonacci extensions. So do not guess the breakout. Wait for the hourly close or the breakout. Trade smart, manage your risk, and I'll see you in the next breakdown.